I should start with you, Connor, since you're sitting right beside me. Why don't you remind our viewers about the mandate of Global Small Cap Opportunities Fund?
Yeah, perfect. Yeah, thanks, Glenn. So, Fidelity Global Small Cap Opportunities Fund, the mutual fund has been around now for just over 2 years in September. Chris and I have been managing the same strategy for almost 5 years. Coming up in a couple weeks, November 4th, we've been managing the institutional strategy. So, same strategy, different product, the replicas of each other. Global, obviously, we can go anywhere. Small cap, we tend to focus on stocks that are between $1 and $14 billion in U.S. market cap, and relatively concentrated. So think of it as 40 to 50 core ideas. Those are our best ideas that we're trying to always push up to the top of the portfolio. And we're trying to just go around the world and say, what are our best ideas? Global, go anywhere, best ideas fund. And we often get asked, why should everyone be considering global small caps as an asset class? And I think there's really three big reasons that we need to talk about. The first is expand your opportunity set. The second is diversify. The third is enhance returns, why we're all here. So if we start with the first one, expand your opportunity set. All you need to do is look at our top 10. And you're going to find companies, they're a little eclectic, they're a little off the run, maybe a couple, but they tend to, things that you're not really thinking about. Mm-hmm. So you just go and you look and you say, okay, Wabtec, U.S. rail and locomotive company. CACI, U.S. government IT company. Leonardo, Italian defense company. MTU, German aerospace company, right? We've owned Swedish tobacco companies, we've owned Japanese media companies, Australian wineries, UK home builders. These are things that most people do not have exposure to. And it's that classic Peter Lynch line, whoever, the person who turns over the most rocks wins the game. We're trying to turn over as many rocks anywhere in the world to try and find the best opportunities. The second one is diversify. So there's a lot of talk about concentration in the market today, right? And you start with the Mag 7, and I think give me some leeway with these numbers, but I think the rough numbers are the Mag 7 represent roughly 30% of the total market cap of the S&P 500. So a lot of historically high levels of concentration. I think the underappreciated aspect of that is I think if you go to the S&P 100, it's 70% of the total market cap, which means that even within the S&P 500, clients don't have a ton of exposure to all those smaller names, and they certainly don't have exposure to a lot of the small and mid cap companies that we play in, right? And I think there's when you expand that, and we can give maybe some unique exposure to client portfolios that don't necessarily aren't touching that. And then the third, obviously, why everyone's here, enhance returns. I think we demonstrated over time that we can generate very, very nice returns both within the asset class and also relative to the large cap indices, not while still investing in the small cap index. So three reasons again: expand the opportunity set, diversify, enhance returns.
Excellent, Chris. I'll go to you just to talk about how you divide and conquer. The two of you are co-portfolio managers on this mandate, and as Connor was just saying, you've got the world at your doorstep. How do you divide and conquer, and how do the two of you figure all of what's available out around the world to put into this portfolio?
Yeah, so it's a bit of a unique structure, the way that we've set it up. So we actually just split the fund down the middle. So I manage half, Connor manages half, and we can invest across sectors, both of us. But we have that built-in devil's advocate. So if we're looking to source new positions, we can have those discussions, debates, make sure that we understand both the bull and bear case of every investment that we look to put into the portfolio. So and it's a true, global go anywhere best ideas fund. Connor's able to put his best ideas in the fund. I'm able to put my best ideas in the fund, and then we're able to utilize, Fidelity's great platform, one of the best in the industry, and our 140 analysts across the globe to put their best ideas in the fund.
Very interesting. And when it comes to capitalization, I just want to go back to the point you made. Yeah. The numbers that you talk about from what defines small cap, they're different than what we hear as Canadians. And I think Canadians can feel nervous when they hear small cap. They think that it's perhaps somebody sitting around a map in Calgary. But it's quite different from what you're able to look at. Your opportunity set's much larger and could be less volatile than what we may be thinking.
Yeah, I think when you look at that, right, as you kind of mentioned. So people hear global, they think exotic. And they think, hear small cap, they think risky, right? And just, to put some parameters around it, when we say global, we are primarily a developed markets fund. So, I think we've been managing the strategy for 5 years. We've owned, I think, one stock in emerging markets. And that company was in Mexico. So think of us more as a developed markets fund. And when you break that down, we are going to be roughly, and I would say historically we've been more of a transatlantic fund than a global fund, but we've been roughly call it 2/3 North America, 25-ish% in Europe, and then we have kind of a sprinkling of Japan, Australia, maybe a little bit of emerging markets, but not much. And then market cap wise, as I said, we play in that, we typically don't invest in things that are below $1 billion. And the top of our range, what we and MSCI define as small cap, the top of that range is 14 billion US. So when you average it out, historically we've kind of been in that $6-7 billion market cap US range, right? So depending on the day of the week, you might sneak into the TSX 60. Mm-hmm. So when we're talking about small caps from a global perspective, in a Canadian context, that might be a mid cap, or some might even, lower end of large cap or mid cap, right? So to your point, I think the average small cap in Canada, if you look at the TSX small cap index, is something like 300 million, right? To us, that's a micro cap, and the types of businesses that populate that index tend to be oil and gas, tend to be miners, tend to be more speculative technology companies. You look at our businesses, the types of business that we're looking for, right? Our quality filter really is profitability, predictability, and durability. These tend to be bigger businesses, more predictable, less cyclical, things where we can kind of have a really good idea what the earnings power of the business is, but ones that are small enough that we can continue to grow. Like Chris and I like to say, what is our job? Our job is to find the small caps on their way to becoming large caps. Mm-hmm. That's success for us.
Then do you have to get out of the stock when it becomes a large cap?
We are not forced to. So, say that top of the range, that 14 billion, we do not have a hard sunset clause. Part of our fund, 20% of the fund can be invested in stocks where the market cap is higher. And that's exactly what you said. If we buy a company that is a $4 or $5 billion market cap and it doubles or triples, well, guess what? That's a good problem to have. Mm-hmm. And we don't want to throw away the research. We may have owned the company for 3, 4, 5 years. We probably know it better than 99% of the people out there. I don't want to throw that research away, and I don't want to throw away a company that might continue to compound. But when we're recycling the capital, if we do sell, we typically tend to recycle the capital back into that market cap range, that $2 to $5, $6, $7 billion range. That's our sweet spot. That's where we've historically found the most alpha, where we can buy those companies where 2, 3 on their way to 10. That's the goal.
Chris, maybe I'll ask you this, and Connor,
can I
I'd love
just add
your...
on to that, Glenn? Just to Connor's point there, we're investing in small caps, right? So a lot of these, companies have, 2, 5, 10 years of runway ahead of them, right? So we can compound, pre-tax at really great rates of return if they're run by great management teams, right? So I think we can get into this later, but, management's a huge focus for us. And we pay a lot of attention to, corporate governance and capital allocation. And when you find these management teams that can consistently allocate capital, both organically and inorganically in their business, that really equates to market-beating returns, and it's something that's consistently underpriced by the market. So we're always looking for these mispricings, these areas in small caps where the market's missing something. Earnings estimates are lower than we believe them to be. And when you have these great management teams, you look out 5 or 10 years, and they consistently beat earnings expectations, and the stocks continue to re-rate. So that's ideally what we're looking for, and it really plays into that sunset, lack of sunset clause that we have in the fund.
Beautiful. Thank you for adding on to that. And I just want to remind our viewers, if you have any questions, do put them in through the function on your app in front of you on the screen, and I'll get them on my screen here. Chris, let me stay with you. As Connor mentioned, the fund has been around for a couple of years. How do you differentiate this relative to competition?
Well, I think it comes back to, our inflection point. We didn't touch on it, but we look for inflection points, mispricings. And so, Connor touched on the quality of businesses that we look for, right? Proven profitable, predictable, generate free cash flow, high return on invested capital, great management team, strong balance sheets, all the good stuff that everyone looks for. But unfortunately, that's very well priced by the market. So, I can't speak for our competition, but I think that, a lot of investors might have a style or maybe a PE bias, for example, but we just focus on inflection points. So, we can own low PE stocks, high PE stocks. What we're looking for is a company that's undergoing some sort of a change. So it could be a positive change, new product, new management team, maybe a spin-off divestiture where we can look out a few years and see, hey, maybe this business is a lot different, and the market hasn't caught up to that. So that's on the positive side. On the flip side, maybe there's temporary dislocations. It could be cyclical, it could be idiosyncratic. Maybe there's a cyber attack or something happens at the company level where, hey, we look at it. This is temporary. The stock's down a lot. I think the market thinks that earnings are impaired, but we think it's more of a cyclical disruption. We can look out a few years and benefit, when the earnings recover, and generally the multiple recovers alongside of it. So we can talk about a few examples of names that are in our top 10 that fit that description.
Excellent. Connor, do you have any thoughts on differentiation relative to the competition?
Yeah, I'll maybe build on what Chris said. So, I think if you invest in efficient markets, you get average returns. We are trying to generate exceptional returns. So we need to find those exceptions. And as Chris said, we're trying to find stocks in kind of two buckets. And those buckets are companies, we call them inflection points, but positive change or temporary dislocation. So in the positive change bucket, we're trying to find things where a company has a new product, or they're undergoing some sort of strategy transition, or there's a management team change, or some sort of restructuring, right? So, or there's a change in industry dynamic, right? And ultimately what we're trying to say is the future looks a lot different than the past. And just to give you, put some context around that, if we just look at the top 10, I'll give you one, Leonardo, right? Italian defense company. What changed with that business, right? So this is a defense prime out of Italy. They operate globally. And, the change that happened was, if you look at, post Ukraine, Russia, right? I think it got revealed that European defense budgets had been cut to the bone. If you go back to 1991, when the Soviet Union collapsed, European countries were spending upwards closer to 4% of their GDP on defense. That troughed in 2022 at about 1.3%. Okay, so you've had this enormous decline in spending, and basically what happened was, you had an invasion. And now, the governments are kind of coming out and saying, well, we need to hit the NATO target, which is 2%, and we probably need to make up for the fact that we have underinvested in the defense base for 30 years, right? There's one country that is currently rearming, that is Poland. They are currently spending roughly 3.7% of GDP, I think, on defense. So, our belief was there's been a structural change in the industry that is going to lift the fundamental. There's going to be a fundamental shift for a lot of defense companies in Europe. So that's why we purchased Leonardo. On the flip side, more idiosyncratic, temporary dislocation. Okay, this could be a company that has, maybe there's cyclical headwinds, maybe there's an operational problem, right? You have a contract screw up, or a price cost headwind. So if you look at MTU Aero, right, German aerospace company that we own, historically was a very high quality company. But then they had something happen. So they are partnering with Pratt & Whitney on a new engine for narrow body aircraft. And that engine, basically, it's called the GTF, the geared turbofan. There's a significant manufacturing issue with the plane, where basically all the planes are having to be grounded, and the manufacturing issue is having to be fixed. Okay, that is a multi-billion-dollar impairment that the company is going to need to hit. So when that hit, the stock traded down significantly back last year. We view that as, okay, this is a temporary hit. They have the balance sheet to absorb the cash outflow that is going to need to happen. And you get to buy this company at a very discounted valuation, but one that still has very, very strong long-term fundamentals to supply engines into the narrow body market. So that's just an example. High quality business, you get hit with a temporary problem that gets you to buy a really good business at a discount.
Interesting.
Can I just on the MTU, I mean, that was an interesting one, because I think the market thought it was like an engineering or design kind of a permanent impairment, right? And we looked at it, we did our work, and took the view that it was more of a manufacturing issue, right? So it leads more to the temporary dislocation. And, the stock was down 25% last summer, 23, and then it's more than recovered that in such a short period of time as the market came around to our view. So these are, just classic examples of, taking advantage of those temporary dislocations.
Makes a lot of sense. Connor, let's talk macro,
Sure.
Just as a departure. We had a question.
It's my favorite topic.
We had a question come in about central bank decisions. We hear interest rates come down. It's easier for small capitalization companies to get going, get loans, and so on. How much do the two of you pay attention to what's going on with the central bank? Does it have a big influence on what you're doing?
Honestly, you have to be macro aware, right? I think you need to pay attention to what is going on, take the temperature of the market. Mm-hmm. Quite honestly, I'm not sure, Chris and I have ever tried to predict the direction of inflation or interest rates or anything. What we do try to do is we try to take advantage of the dislocations that macro variables create. So, here's an example again. So when interest rates started going crazy in 2022, right, and they hit 8% in the fall of 2022. We weren't trying to predict the path, but the path of future inflation or interest rates. But what we were looking at were, okay, which sectors are dislocated because of these changes. So you could look at home builders, and we follow. I like to say some of our best investment opportunities are what we call old research, new events. Businesses that we've been following in some cases for over a decade. Mm. And we're patient, right? Because all of a sudden there's an inflection point. There's either that positive change or that temporary dislocation. We get a chance to buy a stock. So, and a company called Installed Building Products is something that we bought in September, October 2022. And this is a company that had hit a history of reinvesting their capital at call it 17-18% incremental return on capital. They had compounded their earnings at a very high rate. Stock had already been it was always too expensive. But in the fall, we got an opportunity to buy the stock at 10 or 11 times earnings. Now, we got the opportunity because there's a lot of uncertainty, there's a lot of negativity, and we don't know when that is going to lift. But the whole point is, we get to buy a business. The underlying business is compounding their earnings, and at some point, I always like to say, it doesn't matter what stock you buy, within 2 or 3 years, the market figures out whatever uncertainty or whatever problem, right? So as that uncertainty lifts, the multiple re-rates, you make money, higher earnings, higher multiple, higher stock price.
Very good.
Can I just add on to that? I mean, just in terms of macro, it's a long duration, obviously, asset class. We're focused more on like long-term rates if you want to look at valuation levels. So those really peaked out 12 months ago. So when everyone is focused on where near-term rates are going, I mean, that's all priced into the market, right? We still have another 6 to 8 cuts to come that the market's priced in going forward. So it might help some of the businesses out there that have a little bit too much leverage. It might help them maybe stave off bankruptcy. And it might help them restructure. But for us and the businesses that we're invested in, I mean, we actually welcome a bit more pain and disruption because we're invested in businesses that are able to, get stronger by, investing through a downturn and get stronger on the other side. So, if there's, any type of disruption that goes on, it just makes the businesses that we're invested in stronger.
Chris, those businesses, is there tending to be a value or a growth bias to the portfolio, or is it not as relevant?
No, it's not as relevant. I mean, we could talk about different names in the fund that are in the top 10, but it's really an eclectic mix. So we're focused just on industry leaders. If you look down, I guess the list of names that we're invested in. So we want to be invested in, again, the names that have those strong balance sheets, those great management teams that can steal share, and that really accelerates through any type of economic disruption. So. We're risk managers first and foremost. So we want to make sure that, when markets are rocky, we're outperforming and we're able to kind of take advantage of any sort of opportunities that come up when that volatility strikes. And that's kind of been the track record of actually recovering more than the market when skies are sunnier.
AI, we have to go there. We I'm sure can assume that our viewers today have a bias towards AI with the bigger names that they hold, which is why small caps are complementary to a portfolio. But there's ways to play AI through small caps, isn't there? Could you talk about that?
Yeah, one of the, I have had, and I think I'm probably on record going back 12, 18, maybe 24 months talking about, we've been investing in bits, and I think the next decade is going to be the decade of atoms. What do I mean by that? I think that one of the things that has been revealed over the past, let's call it 6 months, maybe a year, is there's been a lot of investment in AI, and the main constraint that I think everyone has kind of been realizing more recently is the constraint on AI is power. And so we have been talking about investment in physical infrastructure, particularly as it pertains to nuclear energy. So one theme that we have had exposure to over the past 12 to 18 months has been nuclear, right? And through a variety of companies. And our view was simply not only for power requirements with respect to AI and some new applications, but also just from decarbonization perspective, the solution is kind of staring us hard in the face. We already have it. We just need the political will and the capital to invest in these, significant long duration assets. And I think what you've had so far, anyone who's reading the news probably knows, has probably read about the 3 Mile Island restart. With Microsoft, has probably read about the data center deals that Amazon is doing with some nuclear utilities in Pennsylvania, right? And it's all of a sudden like we kind of like we're always trying to think, okay, it's that rule of page 16. You don't make money investing based on what's on the front page of the newspaper. You invest on what is on page 16 that's going to the front page, right? So we have, this was kind of our page 16 theme over the past, call it 12 to 18 months, which was no one's talking about this. We think we have a differentiated view, and it's now on the front page. So look, I think that's the key, right? Is like we are trying to always find the more kind of more eclectic, off the run ideas, right? Where everyone's paying attention to AI, and we can kind of go look, widen the aperture, go global, and say who else benefits, right? That's one thing that we love to do, right? You talk about being global. One thing that we like, there's beyond just having going back to that opportunity set question, right? One thing that we love to do is, what are the great businesses in Canada, for example? And just take Dollarama as an example. So Dollarama might be one of the best retail boxes globally. Well, if dollar stores work here, maybe they work elsewhere, right? So what we like to do is, okay, if it works here, who are the other beneficiaries, right? And you can go across the world, just within dollar stores. You can go, B&M is a discount retailer in the UK. Action is a discount retailer in France. You have Syria, which we historically invested in Japan, right? So you just say, okay, who else benefits? The other thing that we like to do is to go around the world and say, what industries exist outside of North America that no one has exposure to, right? So interestingly, just through hearing aids would be one. There's 4 companies that make hearing aids primarily. They're all in Europe, right? 2 are in Denmark, one's in Switzerland, 1 is in Germany, right? Flavors and fragrance, right? If you're eating yogurt and you're eating the cultures and the enzymes that give yogurt its mouthfeel, well, all those products are typically made by either Danish, German, or Swiss companies, right? So you get exposure to companies and industries that you don't have in North America.
On that, you talk about the world. It's a big place, lots of opportunities through Europe, through so many different geographic locations. Chris, you're both located in Toronto. How do you work with the Fidelity resources to absorb all of these ideas? We've had a question come in on sectors that you favor. I'd like to go there in a minute. First off talking though, on how do you gather all this information between company meetings that you may want to be part of and the input from all the research analysts globally that must be coming at you all the time. Chris, could you talk about that?
Yeah, no, we have a great platform and IT backbone at Fidelity. So we're able to join in all of our meetings, company meetings that are hosted globally through technology. And it makes communicating with our analysts extremely easy, especially post-COVID, as being on Zoom and Teams. So we have a unique kind of research system at Fidelity where all analysts across the globe publish their research internally to our note system, so we can get up and we can flip through that. That's kind of the first thing that we do when we get into the office and see what research has been published overnight. And then it just makes it really easy to reach out to and work with our analysts that really sit on the ground in those global offices. So it is, it's a global fund, but having those boots on the ground from those analyst team in those countries, I think is a huge leg up versus our competition.
Excellent. Connor, a couple of sectors that really are standouts for you.
Yeah, I mean, you can see it in the fund, right? Where we have a heavy overweight and have had a heavy overweight within industrials, and that kind of plays on to a number of the themes that we've been talking about. I kind of like to summarize it as rearm, rewire, and reshore, right? I mentioned that Italian defense company. I talked about nuclear energy, just with decarbonization, but also some of the increased power demands, and something that we didn't talk about, but reshoring and the cost advantage that the United States has with low natural gas prices and the the cost advantage that gives them with heavy manufacturing in the United States, and what that is doing to both industrial capacity, bringing it back to the United States. But just historically, currently today, industrials. Historically, it's been fluid, right? If you were to rewind the clock and go back to COVID, we would have had a very, very heavy overweight in consumer. But as a general rule, you should expect us to focus. Chris, or both our backgrounds are conducive to consumer, industrials, financials. So, and I think that's been historically over 75% of our exposure. And that pairs really well, I think, with some of that core allocation that clients might have to who are overweight a lot of those technology sectors, right? And I think we've generated our performance having. It's definitely less than 10. It might be less than 5. Don't quote me on that, but roughly, less than 5%, 10% technology exposure, right? So you can generate returns without being, without looking exactly like what most people have exposure to in an S&P 500 fund.
Excellent. Chris?
Yeah, I just echo that, Glenn. Yeah, I mean, it's just, very idiosyncratic fund, right? Global go anywhere best ideas fund, and a great complement, right? If you have, a lot of US large cap tech, this is small cap, kind of go anywhere, and very idiosyncratic.
All that being said, which we appreciate as listeners, a question has just come in, and Chris, I will quote, "The fund has had an incredible run the last 24 months. Have we, as investors, missed the train?"
Well, look, I mean, market timing is impossible. I will, never venture to call the market, but the good thing is with this asset class, there are always opportunities. Over 6,600 stocks in the index. Volatility strikes at any given day. We're able to take advantage of it. We have 140 analysts that are putting their best ideas in the fund, and you can think about it. It's only 40 to 80 names. The bulk of the risk is the top 40 to 50. We have 140 analysts, so if they all put their top idea into the fund, we would have 140 names, and we're restricted to a name count well below that. So if you think about it, it's high conviction, focused on mispricings, and we welcome volatility because if we have a bout of volatility, that means that there's opportunities we can take advantage of and reap the rewards on the other side.
Connor, any final thoughts as to what Chris just talked about?
No, I think I just reiterate, what we were talking about at the top, right? We often get asked, where does this fit in a client portfolio? And I would just say, expand your opportunity set, right? If you're only in Canada, you're only seeing 5% of the opportunity set. If you're only in the US, you're only seeing 50. So just expand your opportunity set, try and find the best ideas wherever the company might be headquartered. 2, diversify. Let's get some exposure outside of the TS or the core S&P 500 or TXX fund. I think we can give you small, we can give you global, and we can give you those sectors, that consumer, industrial, financials, that bolt on really well. And ultimately, let's enhance returns, right? I think we've shown that we can be a really nice return enhancer for an overall client portfolio.
So great diversity in themes and styles and sectors, but also future amazing opportunities. I love the fact that you talked about earlier, that's what I really took out of it, is you're finding opportunities today that have potentially have a wonderful future ahead of them. And I think that's something that we all should look at as investors. I'm going to wrap there. Chris, thank you so much for joining us. Connor, wonderful to be here at the desk with you as well.